Feliz viernes, YouTube. Mi llamo es Joseph Warren y me gusta el dinero, bebé. Today it's Financial Friday, and the topic is how to choose a stock. Before you can get busy choosing stocks and buying them or selling them, it's important that you first understand what a stock is. A stock is a type of asset that represents partial ownership of a company. So if you have stock in Apple, if you have stock in Amazon, that means you have partial ownership in the company. And if the company does well and makes a profit, then you also do well and make a profit with your partial ownership. If the company does poorly and they're losing money, then you also do poorly and you lose money in that investment. Now that you know what a stock is, I'm going to give you 3 tips that you can use to choose a stock. Number 1, invest in companies that you believe in and support for the long term. A question I like to ask myself in regards to this is, will this company still be around after I'm dead and gone? If you have children or grandchildren, you can ask, will this company still be making a profit and be paying dividends or paying earnings to my children and grandchildren? If the answer is no, it may not be more of a good long-term investment. You may be speculating, which this is not the topic of what we're talking about today. Another thing is to ask yourself if you're comfortable holding this for 15 years or more. Number 2, make sure you understand how the company makes money. If you can't describe in a sentence very succinctly and clearly how a company is making money, you're not ready to invest in it yet. You either need to do more research or choose a company that you understand exactly how they make their money and make their profit. Remember, this is your money, so be wise with it and make sure you do research on any investment that you make. Number 3, you have evidence that the company is undervalued. What that basically means is that you can buy it at a bargain price. Let me use an analogy for this. Let's say that I'm buying a money tree, and I know that the real value of this money tree is $25, and it's on sale for only $10. That's a great deal because I'm buying it for way lower than the actual value, and I could actually make a $15 profit on that. Now let's say that this same money tree, I knew it was worth $25, but they were trying to sell it to me for $75. That's not a good deal because you're paying more than something is actually worth. The same applies to stocks. Any company, you want to look at the value of the company and you want to buy it at a price that's below that. So really a way you can take risk out of the equation, or some risk out of the equation when buying stocks, is to buy it at a very low price. Now, how do you do that? You want to look for things like a low price to earnings ratio, a low price to book ratio, a low price to sales ratio. Another thing to keep in mind is psychology. Know that when something is very overvalued, it's very hyped up. And people who have it are very greedy. They want to buy it they'll pay any amount of money to buy it. They're very happy with their investment. They can't stop talking about it. So if you notice people are like that, that's a good time to actually sell. You want to sell to people who are overly optimistic about the investment. Another way of looking at that is when you want to buy, you want to be buying from people who are very pessimistic. They feel sad. They feel fearful and scared of their investment because they've been losing so much money, it's been basically crashing, and they're willing to sell it to you for bargain prices. Just like when you see fire sales or going out of business sales, look for bargains when you're shopping for stocks. That's a good way of thinking about it. It's basically like you're shopping and you want to get the best deal possible, which is basically the lowest price. Buy low, sell high. I have a chart here to show this. So basically on this chart, you can see that at the very bottom, people are sad and scared. That's actually the best time to buy. When people are overly exuberant, super happy, optimistic, and greedy about their investment, they can't believe how smart they are, those are the people you want to sell to. So ideally, the way the stock market works is you get a chance to have partial ownership and to support companies that you believe in over the long term and help them to make money and grow the business and make even more profits. And over time, that might get out of hand. People might get overly optimistic, and that's what causes market corrections and markets to go down. And that's actually an opportunity. When the market goes down, that's an opportunity to buy at bargain prices, at sell prices. So happy investing. If you have any questions, feel free to drop them below, and I can make it for another Financial Friday. I'll be talking about different asset classes or different ways that you can park your money to bring you value in the future. And hasta la vista, baby.